with DePIN. Let's step in.
For coming today. So, although I am co-founder of KRNL with Tahir, I'm also one of the co-founders and general partners of a venture capital fund. So while he covers technology today, I thought I would take the opportunity to just give information about the investment landscape, being an entrepreneur, raising venture funding, and how this whole industry looks like. I'm sure a lot of you guys have seen, technology companies go from nothing to being worth billions. I'm sure many of you have seen what goes on in like San Francisco and Silicon Valley and that American dream of how companies just come out of nowhere. Now, the beating heart of all of that innovation is also, the access to funding. So that is a key component of ensuring that we continue to have innovation and technology continues to win. So to start with, I'll give a brief introduction of myself. I'm a mathematics graduate. I started my career in actuarial science, like statistical forecasting, risk management for institutional investors in the UK. So I used to work as an investment consultant, helping them create complex like asset liabilities, matching strategies, and investing across many different asset classes. It was actually during doing that, I was looking for new ways of investing, new assets to invest in, that I actually came across Web3 and Ethereum. So I came across Ethereum and I felt that this technology based on zero and ones as a mathematician would help us create a societal like structure as well as financial systems which are a lot more clearer and again effectively based on mathematics, on zeros and ones, rather than whether it's governments or banks or anything like that. There's just a lot more freedom in a trustless society where you know exactly what you're getting. So I went down the Web3 rabbit hole, but in terms of my career, around that time I also passed the CFA exams and became a CFA charter holder in investing. And I moved to London and joined BlackRock, the largest asset manager in the world, with I think around between 10 and 12 trillion dollars now under management. And it was actually while I was there I met like-minded people on the Web3 side who shared the same, you could say, ambition as myself, and we decided to launch our own venture capital fund. So this fund, Eterna Capital, we launched that in 2018. I actually have been in crypto since 2016 when I first invested in the space. And since 2018, Eterna Capital has invested in probably close to 50 companies and deployed around $50 million. And we're actually launching our third fund in about a month from now as well. And I'll go more into what that actually means. Along the way, like Tahir mentioned, about 2.5 years ago, we met. And I went from being a venture capitalist who invests in startups. I am now also an entrepreneur and co-founder of a business which itself is venture-backed. So it has also received funding. So I've been on both sides. Actually, it's quite ironic. So when I was an investment consultant, investment managers used to sell to me. And I joined and became an investment manager. So I moved to the other side of the fence. Then in my career, I became a venture capitalist, and startups used to sell to me, and I used to invest in them. And then I moved again to the other side of the fence and raised money from venture capital. So it's actually quite interesting how my career came together. I didn't really think of it that way until I just saw it on paper. So investing in 2025. So before we go into that, what is venture capital investing? So what is the strategy? What do they do? So effectively, venture capital is about investing early into companies, what we would call pre-seed, and all the way up to Series A. So pre-seed you could think of as, I have an idea, I need funding to test it and see if it goes somewhere. It may not, but as an entrepreneur, I may start building one thing, but I might end up somewhere else. So it's very risky. Will you give me money, right? So a venture capital fund will be like, okay, you're an exceptional founder. I want to back you. I believe in you. It's a big risk which you're taking on a person more than a business at that point. It's more about people than it is about business and money at that early stage. And you basically take a chance on somebody. So as you can imagine, for the amount of money you put in, you will get a bigger percentage of the company because you're taking a higher risk. It's the early stage, the company's worth less, your money is worth more. Seed stage is normally the product's being developed a bit further. You get some early signs of what they call product market fit, which is the idea that product market fit in different industries means slightly different things, but at a high level I would generalize and say somebody not only wants your product, but most likely needs your product and is willing to pay for it. It's not just a nice to have because you offered it for free, but someone is willing to pay for what you build. And that's like early signs of product market fit. And then Series A is normally people want my product. But my biggest problem is I have a lot of demand, but I can't satisfy the demand. I need to scale. I need people. I need to scale my technology so I can meet the demand and grow. So you're at that point where in the hockey stick journey of a startup, you're about to go through that exponential phase of growth, and you really need people or your technology to scale, so you're taking funding. And as you can imagine, there's less risk in a company at that stage because they've proven it. Now it's a case of how high can we go, how much money can we make, can we hire the right people, can we ensure we don't make mistakes. As you grow with regulation comes after you because you're now noticeable, competitors come after you because you're doing something that can make money. So you need to ensure you have a competitive advantage. So the questions, the story changes quite a lot. So, so I've kind of explained the stages of the company. Now, the way a venture capital fund works is, almost every company you invest in will fail. But every single one you go in, you think it's going to make it. You think it's going to make you somewhere like around, let's just say 30 times your money back. So you put 1 million in, you think you're going to get 30. Now, if that's the case, and the majority fail, let's just say 1 in 10 fails, but the 3 out of the 30 would then succeed. If each of those does 30x, your fund is up to, let's just say from 30 million to like 90 million. So even though 27 companies failed and you went in with every single one thinking this one will make it, you just don't know which one will, and often the one that does will surprise you. So the way a venture capital fund works is they try to add value, they try to support you and make sure that you succeed, but they have investors in them and they need to make sure those investors make some money back. So if you're a company that's doing really well, it's easy to turn a company, I wouldn't say easy, but it's easier to turn a company who's up 20 times to make it 30 times. But if a company is only up, 1 time, like it's basically flat, would you spend your time to try to make that double in value? Probably not, especially if it's failing. So what you do is you back your winners and you try and make them better. And it's just a game of numbers. You don't have enough resource to push all your portfolio companies, and that's, I guess, the harsh reality. And people say the journey of a founder is very lonely, and this is why it's a bit like in life. When you need your friends the most, they may not be there. But it's one of those where everyone's incentives are aligned towards generating wealth. So, should you take money from venture capital funds? I think moving on to a bit about investing in 2025, the climate particularly, and I will focus on Web3 venture capital, is such that there is a lot of fear from venture capital funds in terms of the way that early stage investing happens is once the money goes to the founder has a lot of rights, a lot of power, and the venture capital fund is just a passenger. So a lot of founders have misused that relationship, or misused funding and other things to be very opportunistic. in an industry which is innovating at such a rate that we are effectively funding experiments, and you just don't know which experiment will work. If we zoom out of Web3 every 4 or 5 years, I think we are always progressing as an industry, but there's so much wastage, and that's just how it is when you're funding innovation. But I think a lot of that has been misused or abused by opportunistic people. So we've seen the industry move to a place where investors are quite a lot more cautious. So what does that mean in terms of raising capital? Founders are having to bootstrap for longer, which basically means they are building the product longer themselves to take risk off the table, to demonstrate they are in it for the long run, to demonstrate they are willing to put their own money into it, not just take someone else's money, abuse it, and who cares because I didn't put anything of my own in. They are basically, founders are now being asked, bootstrap, prove the product market fit, prove the technology, build enough of it, show me proof of concepts, show me you're willing to be in this industry, because there's 50 others doing like you need to prove that you stand out even more. So it's a bit like the journey of graduates compared to say 20 years ago. If you want a graduate job, it's much harder now. Sometimes you need extra work experience, you need, it's the same as a journey as an entrepreneur if you want venture capital funding. The competition is there because people, want access to this money and the journey is a lot more understood. So if you really want to achieve it, you need to basically demonstrate more. Now, some key themes we've seen from venture capital funds, because of some of the, you could say, distrust of founders, a lot of people have looked at the market and have been thinking to themselves, as a venture capital fund in Web3, I'm in a unique position where, the beauty of Web3 is the liquidity can come early, but it's a double-edged sword. Because of the tokens, you can actually, release something before an equity company does an IPO. But it also means that there's a lot of market, or there's a lot of opportunity in the liquid market, in companies that are already proven. So some people are like, hey, over a 5-year period, I might make 10 times my money just by putting it into Bitcoin. That's better than most venture capital funds will achieve. Why am I taking the risk with startups? Why am I backing entrepreneurs? Why am I spending all my time helping 30 companies when I don't need to help Bitcoin, right? But I can make the same return. Maybe some from a risk, risk return perspective, risk adjusted return, may see it as more favorable. Some maybe less. Some are thinking you can't achieve the same as VC, and that's it. Everyone has their lens on how they see the world. But some VCs, because they've raised so much money from their investors, have decided instead of going into 50 different startups, maybe I'll go into like 30 and I'll put some in liquid. So it's been an interesting theme. It's not really what you would call a venture capital strategy, but it's important to know how it's actually happening on the ground. So I felt like that was worth covering. I'll actually mention the last one because it relates to that. So some people are not necessarily allowed to go into that liquid investment. And investor will be like, I gave you money and you put it into Bitcoin. I wanted you to put it into startups. I could have got into Bitcoin myself. Why am I paying you fees, right? So what some people have done is they've gone into these leveraged products where effectively, I'm sure many of you have heard of this company in the US called MicroStrategy, which is a listed company and is effectively just borrowing money and buying more Bitcoin. And they just keep doing that, so they have a very leveraged position to Bitcoin. Now, some people are using that as a bit of a gray area as a VC and saying, hey, I'm investing in a MicroStrategy competitor. It's a startup company that's buying Ethereum, borrowing money and buying more Ethereum, borrowing money and buying more Ethereum. It's venture capital. It's a startup, guys. But really under the hood, what are you doing? You're taking a leveraged position to a very highly a high market cap company, like a project like an Ethereum or a Bitcoin. Now, in between that, so this has been one of the cycles where I felt we've had one of the least amount of innovation compared to previous cycles. It's actually been pretty boring. But some of the key things, which is not an innovation of this cycle, but has been really powerful and is really leading Web3 is stablecoins. And how people are using stablecoins right now. but there's not that much of a VC like funding opportunity there. There's not much to do. It's just amazing from as a fan of Web3 to zoom out and see how that's impacted the market. But in terms of investable opportunities, DePIN is an area which is growing. I think this area of the world is one of those where, particularly given the focus on hardware manufacturing, a lot of great technology companies in this area, DePIN is something which will, I think, be quite impactful in Southeast Asia. When I got involved with Helium, it was actually because of a company, a VC friend of mine who was out of the US. They were an early investor in Helium. Before it pivoted into Web3, they invested in one of the earliest rounds, and it wasn't focused on the community running these things. They just thought they would strategically position these and work directly without having a decentralized business model. But this company, these investors, they basically were part of the journey to make it decentralized. And when Helium was looking to expand into Europe, when they created the European frequency device, we were the first partner of Helium, and we helped them distribute over 3,000 devices over Europe. So the first shipment of Helium devices to Europe landed at my door, at my house. And I remember the day, it was a big box. So we've followed that journey, of DePIN quite a lot. There's a lot of good things and bad things about the industry, but at the heart of it, DePIN is a key component of the, you could say, the physical infrastructure for the next layer of the internet. So when we move to a vision of the internet which is more decentralized and more open and accessible by everyone, DePIN is a very important layer in that vision, and probably one of the ones with the largest opportunity, because a lot of the other things which are more software focused, the innovation has been much stronger and a lot of the opportunity has been taken. But when it comes to the physical side, there's a large opportunity there, and this is where I think Southeast Asia, with a lot of the focus on physical hardware manufacturing and focus on building technology, there's a significant opportunity. Now AI, Tahir spoke at length about the opportunities and threats of AI. Everyone knows and uses it to some level. Now, that sits very well with Web3 because, there's a lot of examples of people trying to do things with AI in Web3, which has really been, a bit like the AI space itself, lots of ideas of things which won't work, right? But what Web3 really brings and really solves the problem for AI is Web3 is predicated on this idea of verifiability, trustless, immutable ledger. And if you look at AI, which feels like a black box, then this verification, this immutable ledger, the accountability, the transparency of Web3, it really is a match made in heaven. And if basically Web3 plays this, acts appropriately and plays this opportunity well, Web3 could piggyback on the proliferation of AI and disseminate throughout our tech stack globally and become a critical component just by following the journey of AI into the wider market, into enterprises and elsewhere. Now fundraising, I covered a bit of this before, why raise from VC. So, if you're building a business, I always joke with people and say, you're just selling rugs. If you're selling carpet or something, you're maybe making a business which, as you get more sales, you need more people. It's not something that venture capital would be interested in because it doesn't scale to the level that they need. If you're building like a consulting practice, if you got 20 clients and you got 5 staff, but then if you got 40 clients, you now need 10 staff. Your costs are going up as your revenue goes up. Doesn't quite, it's not what they're looking for in terms of this hockey stick. Where venture capital comes in is basically you want to build something which is, significantly scalable or sometimes even infinitely scalable, where your costs don't increase significantly as you take on more customers. And your customer base, you could say what they call the total addressable market, the TAM of your business, is significantly high, and there's the opportunity to go from nothing to becoming a unicorn company, something worth billions of dollars. That's normally where you go. To go on that type of journey as a founder, it's very difficult because those types of businesses, those types of products take a lot of investment before you see your first customer. If you're selling rugs, you buy a rug, you sell it to somebody, you save money, you use that money, you buy another one. But with some of these companies, like a great example in Europe is a startup bank called Revolut. Revolut have been unprofitable for, I'm sure it was for more than 5 years. Only recently they've started making profit, and not a significant amount as well. We're talking like maybe $10 million a year, but the company's worth tens of billions now. But that journey to profitability and to that type of valuation was a hard one, and revenue was never large enough to cover the costs. There was many times they were, fined by regulators and things like that. But what you need for being at a company like that, or being a company like Apple or Amazon, is you need to build a product which is very investment intensive. So you basically say, investors, join me on this journey. Join me on this journey, and they are happy because you meet that return profile I described before. So yes, so that's effectively what they're looking for. They're looking for a scalable idea which has the opportunity of capturing a large addressable market and building valuations to the point where your company could effectively one day IPO, or in the case of Web3, ICO or launch token at some point. Now, I just mentioned tokens, so I'll just cover that as the last slide of mine. So another area, which is obviously unique to Web3 investing is the idea of tokens. Now, tokens are also part of, the success of Web3, but also the failures in some way. It's itself a very experimentational area. Different types of projects have different types of what they call tokenomics designs, and they can vary, and they are always evolving with market, you could say, dynamics changing over time. One interesting thing we saw was, I remember in 2017 when you talk about the ICO boom. If I invested in an ICO or participated in fundraising in any stage of a company, when the token listed on exchanges, that is when I received all my tokens. And I could sell them immediately. Or I could choose to hold them, but the decision power was mine. The market evolved, it learned a lot. A lot of these projects failed because that much selling pressure on day one in an uncontrolled way is effectively unsustainable. 2017, it was managed, it was handled because there was such euphoria amongst retail investors on the exchanges. They were eating it up. Also, from 2017, you earn your tokens over time, and a model that has worked, to some level over the last, since 2018, 19 onwards, has been that as a bit of a default, it was like 1 year of a cliff where you receive none of your tokens, and then you have like 3 years investing. So over a 4-year period, investors get their tokens and then they can sell it, because over those 3 years where it's vesting, it's normally done in a linear way. Now, that worked to some level, but there's been, some interesting market dynamics over the last couple of years where founders have abused this. And the selling is just acute. You've got investors, you've got founders, you've got employees, and you've got retail investors who maybe participate themselves in some kind of ICO funding round. And the way tokens are launching these days, and I'm sure many of you have seen, they start high and go low. So if something starts high and goes low, if you're first in the queue, you have the highest probability of making money because you're the first ones to exit. But whatever happens, everything seems to be going downwards by the end. So it's a very ugly dynamic right now. It's pretty brutal. And venture capital funds who used to be at the front of the line have actually these days found themselves almost and often at the back of the line, even behind retail. because retail now are sick to death of being the last ones in the queue, and since 2018 onwards, they have become wise. And what makes you learn more than anything else? Losing money, right? So a lot of people have lost money and realized that, look, we don't want to go into these types of things. But interestingly, and this is an interesting market dynamic which I've noticed over the last 6 months, is we seem to be going to a bit more of a compromise investing schedule. So from 0 to 1 year cliff and 3 year vesting, we're now at the point where people are doing things like 1 year cliff and 1 year vesting, or no cliff and 1 year vesting, or no cliff and 2 year vesting. So can we reach some kind of compromise so investors get some level of liquidity earlier, while still making sure that the market can handle the downward pressure? I'm not saying there's some winning formula, but these dynamics are changing as retail appetite changes, whether we're in a bull market or a bear market, and generally, when there's a lot of factors that come into this. And I think one thing which may have contributed quite significantly to this change in investing is basically what's going on in the US administration to do with their view towards blockchain, cryptocurrencies, Web3, and stablecoins. What's been going on in the US recently has been quite a significant shift where Web3 is being seen as something which they want to excel at and not fall behind on. Stablecoins are strategically very important to the US. US dollar tether, USDT, is I think the 17th largest holder of US treasuries in the world. I think South Korea holds US treasuries around the same as US dollar, as the stablecoins bring. So it's equivalent to countries, the amount that's being held by these stablecoin providers like Circle and US dollar tether. So it's quite important for the US from a US dollar dominance perspective for the world to keep using the dollar as, you could say, the dominant currency, the one that everyone wants to hold. If you're in a country like, Colombia or Venezuela, where there's a lot of, hyperinflation, you want to be holding the dollar. And the US wants you to be holding the dollar. So with the US becoming a lot more, you could say, loose in terms of, and more open towards Web3, I believe that is one of the key factors why some of these companies are now more comfortable to have smaller vesting schedules. Because before that, some of the large venture capital funds like Andreessen Horowitz, A16Z, they were basically putting out blogs about 1 year cliff and 3 year vesting. Because anything less than that, the US could come after you. Because they feel like you're just harming investors, harming retail, selling it like a security. You're not selling it based on utility. So they put these strict things. But now the shift in terms of the vesting makes me realize that it's the macroeconomic changes that are impacting how people are thinking about these things. Now, I mentioned about retail. Retail is different, country to country, and projects focus on different countries. So there, demand from retail changes. Some ideas are just a lot more sexier to retail than others. And these things change. Narratives change all the time. And Web3, for better or worse, is quite a narrative factory. We like to hype things up, see a lot of opportunistic things come in, and then watch them fail. And this cycle of, you could say, narrative churn is very fast in Web3. Honestly, sometimes I think the marketing firms are making more money than everybody else because they think of new narratives all the time and sell it to the market. And whatever happens as a service business, they're always printing money from the projects who are effectively funded by VCs. And then exchanges. Now, I mentioned already about the fact that this cycle's not been that great in terms of innovation. But one of the key things we're seeing, and I think this is more of a theme for the next cycle, is there's certain companies like Hyperliquid who have effectively shown promise that a decentralized exchange can start competing and maybe outperform centralized exchanges. And I am of the view that, like most people, that centralized exchanges hold too much power. They control pricing, they control success and failure of projects to a higher degree than they should. And this is something which, if you could say, as a community, we manage to move more towards decentralized exchanges having more power, having more influence, then we will only benefit more from it because of the transparency this will bring to the market. And I think that's a key thing for the industry. But if you're a founder right now, it's very hard to be successful with any token strategy you have without exchanges. So right now you cannot, and that's basically a problem as well. But for now, you have to honor that, and you have to work with exchanges. You have to strategically pick them. You need to make sure they don't ruin your token. As much as they are helping you, they could also be your biggest failure. There's a lot of exchanges with very bad reputations, and they can cost a lot of money to list on as well. So if you're looking to launch a token, it's important to get your tokenomics right. It's important to think about how vesting fits within that tokenomics strategy. You need to think about how you can get the attention of retail. Like, you might be building something useful, but why should a retail investor care, right? Why should they attract them? What's their appeal? So you have to know your audience and think about it. You can't just launch something and think somebody will buy it, or someone will buy it because it's on an exchange. No, you need to really connect with your buyer and make them believe they are part of the journey and feel part of the journey, and effectively allow them some level of entry point where they feel like they will be financially rewarded, because nothing builds a better customer base or fan base than allowing them to have some level of success in your journey. The worst experience is someone really believed in your project but then lost their money. You don't keep someone for 5 years or 10 years that way. If you look at companies like Chainlink, who are launched as an ICO in 2017, they have a massive following, and this is because they did right by their investors from day one, and a lot of people made money to the point where they are almost like a religion to these people. That's how the type of cult following that they have. But in the future, my hope is that when it comes to token strategies, exchanges we talk more about decentralized exchanges than centralized exchanges, and I believe, well, I hope by the time we hit the next cycle, if we're talking again in 4 years from now, that we are in a situation where the influence of the centralized exchanges and their cartel in some ways has less dominance, and the market is more open and free and more aligned with the vision of Web3 and how it was, you could say, promised to be. That's going to be, I think, one of those utopian dreams of mine, which I think we're seeing the early signs of it with things like Hyperliquid. With that, I'm bringing my presentation to an end. If there's any questions that anyone has about investing, startups, fundraising, or tokens, happy to answer. Otherwise, that's it from me. Thank you very much.